First, let's just talk a little bit about what these indicator labs are. We do not recommend one indicator versus another. Our goal is simply to let you know used over the years to see if you want to integrate them into your trading plan or not. So what we're going to discuss today is one called the Commodity Channel Index. We'll go about how it's built and how people use it. All right, so this indicator was developed by a fellow named Donald Lambert in 1980. Donald Lambert was not a trader. Rather, he was a mathematician hired by a group of traders in Chicago to help them try to detect and trade breakouts in commodities futures contracts, hence the name Commodity Channel Index. But of course, people use it for equities as well. What he attempted to do was simply try to see if something is moving away from its statistical mean price. He did all these calculations on a Texas Instrument handheld calculator, which was kind of state of the art back then in 1980. Very interesting. Anyway, so the way he set the formula is that took a look at price series and set the formula so that what typically was considered to be a random price fluctuation, 70 to 80% of those would make the indicator fall within a channel of negative 100 to positive 100, hence the name Commodity Channel Index. Now, this can be used as an oscillator, in other words, to look for overbought or oversold conditions. That is one of its uses. It's important to note though that many oscillators like stochastics or relative strength index are what are called banded. The formulas normalize so they can only take on values between 0 and 100. This particular indicator, though, is a non-banded indicator. In other words, the formula can let it take on any values. But once again, the way he set it up was what are considered to be random price fluctuations should keep the indicator somewhere between negative 100 and positive 100. Now, in order to figure out what the statistical mean price is, you've got to look back a certain number of periods. I say periods because you can use this indicator on daily charts, intraday charts, weekly charts, whatever you like to look at. Now, talking about look back periods, this is not necessarily unique to the Commodity Channel Index. If you use indicators with too short a look back period, you get into the moves quicker and out quicker. You also get what is called whipsawed. In other words, the indicator will flash a signal and then very soon after could flash the signal going the other way if it is too sensitive. On the other hand, to smooth out the whipsaws, you can lengthen the look back period. The problem is if you lengthen it too much, then too much of the move already has happened before the indicator picks it up. So it is always a balancing act between sensitivity and getting in too late. Now, Mr. Lambert had an interesting take on it, especially for stocks or commodities and ranges. If you can identify some sort of cyclical component, so take a look at the chart there, right? It's a trading range, and it looks that we hit the low of the range about every 24 to 25 days, if you counted those bars. What Mr. Lambert says, if you can identify a cyclical component to what you're trading, which you can't always do, especially for range trading, if you can, then you should set the look back period to a third of the cyclicality that you are witnessing. So for instance, on this chart, I I said it was making a low about every 24 days. So I set the look back period, you can see there at 8, and it was pretty good at picking the inflection points. So that is one way to set a look back period. Most authors, though, just suggest, depending on what you want to use it for, set it between 5 and 25. Many people use 20 as a default because there are generally around 20 or 21 trading days in a month. So some people like to have a month's worth of data. Okay. When we go over the different uses, one of the uses we'll talk about is divergence analysis. We'll explain that later. But if you're using it for that, maybe you decrease the look back period from the default of 20. If you are using a longer term trend following approach, maybe you is again one of the ways you can use the indicator. Maybe you can make the look back period a little longer. But again, if you read all the literature on this, most people use the look back period somewhere between 5 and 25, and there's nothing wrong with just using the default of 20. All right, so that is the background. And how have people used this indicator over the years? Different methods, and they are broken down into subsets. The first, you can use it to be a trend following trader. We'll talk about the two main methods that have been developed if that's the way you want to use it. The methods are called 100 line breakouts and 0 line crossovers. The second, as I said, you can use it as an oscillator. In other words, for range bound stocks to try to pick tops and bottoms with a little bit more accuracy. And you'll see that there are 3 methods that have been developed over the years if that's how you choose to use it. There's something called the single line method, the 2 line crossover method, and the nesting method. And of course, we'll cover all of those. And finally, like I said earlier, if you want to use it to pick up divergences, we'll talk about what that is. Sometimes you make the look back period just a little shorter than you might. And we'll talk about that one too. Okay, so this is the original method that Donald Lambert came up with. It was a way to mechanically look for breakouts in commodities contracts and to trade them for commodity trend following trading systems. Now, this method, the rules are you get into a trade on the long side if the CCI crosses above the 100 level. Why would you do that? Remember, if 70 to 80% of what are considered to be random noise would make the value of the CCI be between negative 100 and positive 100, then if, let's say, you got a reading above positive 100, it could mean that the price action is no longer random, right? And it could mean that an uptrend is starting. So that was the system originally. So I have on this chart a trade based on the original system. The first orange arrow is when the CCI crossed above 100, and you just stay in that position until it clearly drops down below 100. Similarly, you would have had a sell signal when it dropped below negative 100, which would have been right there, and you would stay in that short position until it crosses back above negative 100. So you can see you had 2 pretty good trades based on that original system on this chart. Now, many people, including me, think that that isn't the best method to use. Many trend followers would use what's called the 0 line method. Very simple. You simply buy when the CCI goes above 0, and you sell when it goes below 0. This can get you in earlier, and it keeps you from getting wiggled out as often. Okay. Notice, so I have a trade on here based on the 0 line crossover system. The first orange arrow, you can see the CCI goes above 100, above 0. that would be your entry, and you simply stay in the trade until it drops below 0 on the long side. Then you could either, if you want to do reversal trading, you would actually go short, or many people just go flat. In other words, they go long and they flat, they don't go short. Notice how this compares to the 100 line method. Notice if you're using the 100 line method, you would have gotten in here, but you would have taken right out. You would have got in here. Yes, you would have gotten a okay little trade, but then you got taken out. Again, here you got in, you got some of the trade, but then you got taken out. Now with the 0 line method, you can get bigger, longer moves. So it's up to you which method that you want to use. All right. Next, if you have a stock that is relatively range bound, like this one is here on this chart, for instance, you can use the CCI to help you get a little bit more accurate in trying to buy near the bottom of the range or sell near the top of the range. So in this method, if a stock is range bound and the CCI breaks the negative 100 method, the 100 line rather, the stock is considered to be oversold. And just like with any oscillator, you're looking for an oversold condition to mean revert, to get at least back to the middle of the range. With the CCI near the bottom of the range, that would be when the CCI is below negative 100 and crosses back above negative 100. So those would be the green signals on the chart. You can see they were pretty good at picking what day to buy near the bottom of the range. The signal on the upside, when you get overbought, is you look near the top of the range when the stock is near resistance, and then you look for a drop of the CCI from above positive 100 down below positive 100 to sell near the top of the range. So you can see here the signals are the red arrows. Again, not too bad. There have been other ways, though, to use the CCI as an oscillator in a range-bound stock to get maybe even a little bit more accurate signals. And there are two methods for this, where you use more than one CCI line. Okay, so the first one we're going to talk about here is what is called the two-line crossover method. In this method, what you do is you start with a CCI. Again, you could use the default of 20, and then you add another line in the same study panel with half the look back period of your first line. I will show you a little bit later how you do that on the software. Here, what you do is you look for times when the short line, and ones with this lower look back period, crosses the longer line. So in this chart, the shorter line, the 10-day CCI, is the red line, and the blue line is the normal 20 CCI. You look for times that the 10-day CCI crosses from below to above the longer line when it is at or below negative 100, and then you get out of it at the top of a range when the fast line crosses from above to below the slower line when they're at or above positive 100. So you can see sometimes you can get out and in a little bit earlier with this method. A good example is this sell signal where I have the blue line at the top there. Notice how the 10-day CCI is above 100. It crosses below the 20-day CCI, which is also above 100. You would have gotten out here, versus if you were using the single line method, you would have not gotten out of that stock until the regular CCI line crossed the positive 100, which was at the end of this candle. Similarly, you can see the entry here was a little bit earlier than you might have gotten in with the single line method. Once again, here you got out much earlier than with the single line method. Here's another way to use multiple lines. This is kind of interesting. This is called the nesting method. All right. So here again, you start usually with the standard line, which is 20 periods. But again, you can adjust it if you want. And then you add another line, which is 1.5 times longer than the first line. So if we're using a 20 period CCI as the first line, the second line would be 30, 1.5 times 20. Here, you are not looking for crosses, but you are looking for when the two lines change slope at the same time. That is called a nest. All right. So you can see several on this chart with the vertical white lines. Notice how the lines don't cross, but they turn up at the same time. That has to happen though at the border times when you're below -100 or you're above +100. So you can see the lines didn't cross, but they turned at the same time. That is the signal. And then finally, we talked about divergence analysis. Divergence analysis is not by any means unique to the CCI. You can use it with a lot of momentum type indicators. And all a divergence analysis says is usually, as we see, the CCI tracks the price, right? We go up, the CCI goes up. We go down, the CCI goes down. We go up, the CCI goes up. So here, in the middle of June, we go up with the price, the CCI goes up, we pull back, we go up, make a higher high with the price. Does the CCI line make a higher high? No, it does not. All that means is the momentum taking you to that second high was maybe a little less the momentum to the first high. A decrease in momentum doesn't have to mean the trend is going to switch, but it could mean that. So it's just a warning sign. And what most people do is look for some price confirmation to confirm. So at the second high there on that day, we made a higher high intraday. The CCI was nowhere near the previous peak. So we figure the momentum might be waning there. And now we're looking for some price sign that the weakness is going to happen, because you need confirmation, because number one, it could just mean a little bit of a pullback. Number two, they can last a while, divergences, and they don't always work. So you do need some sort of confirmation. But I think you get it pretty soon on this one, as you easily take out 2 days worth of lows on the day after the divergence. So I was giving you a heads up, and it turned out to be a pretty opportune time to sell. All right, now we're going to go over to the software. I'm just going to show you a couple things you can do with the CCI. All right, so let me just show you how to put things on the chart. So what we're going to do is we are going to go to our chart window here. We're going to go to Studies, View All Studies, okay? And it is under Momentum. It is a momentum indicator. We're going to do Commodity Channel Index. And here is the look back period. So we'll just set it for 20. And you can make the line any color you want. You can make it any size you want. And you put it on the chart. Okay. So what signals do we have on this chart, for instance? Well, as I said, I tend to like the zero line crossover method. So we got a buy in here as it crossed above zero. And we just stayed in it, and we would have taken a profit in here. Similarly, on the downside, we got a sell signal here, and we would have gotten out of that here. We could have whipsawed a little bit, but a lot of people like that. Can we show it on the SPX? Sure. All right, so again, for trend following, I like the zero line crossover method. So we got a signal basically here. Was that April 3rd? Okay, the first profit you would have taken is here. Not a bad move. Then we got another signal here, which we are currently in. Now, the next thing is a lot of these stocks are not range bound. The things that they're trending. But if you did want to look at range bound stocks, you need to know how to put more than one line in a chart, right? Because you need at least two lines. So let me show you how to do that. All right, so we're going to go to the commodity channel index. And first you start with a line. And again, we could use the default of 20, and we are going to, you got to do this in 2 steps. We're going to just add that to the chart. Now, let us put in a 10 period CCI line in the same study panel. How do you do that? Again, you go here, you pull up another CCI, change the color, but here is the trick. You don't say show in new pane, you open this up and you choose the pane where the CCI is already in there. And now you'll have both lines. Oh, I didn't change the look back period. That was dumb. Let me do it again. All right, so we'll get another one. We'll make this 10 periods. And we'll make it red. And again, we will put it in the panel with the other one, and now we'll get both of them in the same panel. Also, if you want to use Donald Lambert's original method and you want a way to find stocks that are doing that, you can use this tool here, Launch Tools, Recognia, which is a third-party technical analysis tool, which I already have launched, okay? And then what we do is we go to Technical Insight, and then we go to the screener, Advanced, okay? And we look for, so I'm going to get bullish oscillator signals. And there's the commodity channel index. Now, when you're using Recognia, we do a whole, Nina Milovach does a whole webcast on Recognia. But I just want to point out in the context here of the CCI, as I said, there's many ways, okay, to use the CCI. So when you are looking on Recognia for signals based on indicators, you have to know what method they are using to generate the signals, okay? The way you do that is you go to the education link and you go to the signal that you're interested in. And so we go to oscillators and we'll go to the commodity channel index. And okay, it gives you the formula. And now, let me make this a little bigger. What signal do they use? They use the classic Donald Lambert signal. A bullish event occurs when the CCI crosses above the 100 line. A bearish event occurs when the CCI falls below the negative 100 line. Okay. All right. So now you know how the signal is. So what you want to do is you can go back to the screener now that you know it, and you can get some signals based on that particular use of the CCI. So we're going to go to advanced. Again, oscillators, bullish, if you want the bullish signals. And we're going to go to commodity channel index. We can put in some price and volume figures if we want. And we'll see if we got any as of Friday's close. Yeah, we did not get any as of Friday. So let's just get some for the last week. So we'll go back here. And we will just go back. Let's go to the last 7 days so you can show some. Oops, I must have done something wrong. Let's go back here. I do. Maybe we're just not getting any. Or maybe the screener is not working. Yeah, we're just not getting any, maybe. Or it could be down. But anyway, that's how you get them. All right. What is the highest values you generally see the CCI go up to the minimum value? Is there any intelligence you can derive from comparing two stocks that build over 100? Well, the higher the level, the stronger the trend. So, you can get, if you want to see how high it can go, just pick a stock, that is kind of parabolic. Right. So, I mean, you got up to 300. So you can get much above 100. If you're trying to compare two with the same momentum, then the higher CCI value would have a bit more momentum to it. All right. We have another question. I wonder if the CCI is a popular way of picking weekly general market tops and bottoms. I think for divergences, perhaps. In trend following, remember, trend following doesn't try to pick tops and bottoms. So if you wanted to use it to try to pick tops and bottoms, you could look at weekly charts for divergence, for weekly chart divergences. That would be the way to try to do that. You can also get the slides for today's presentation by going up to the top of the screen you're on. Click on the resources tab. It'll open up the different categories, go under technical analysis, and you can get the slides. All right, coming at the top of the hour, we have Nina Milovach and Kevin Green. Nina Milovach, former CBOE market maker. Kevin Green is one of our derivative trading